Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. Hey, good morning, everybody. It is April 20th, Tuesday, April 20th, 10 a.m. I feel like I say it every Tuesday, as I always say, but it looks like it's going to be a beautiful day, so I hope you all get outside today. We have several new people on the webinar this morning, so I just want to give a little rundown and a little reminder of what we do on these webinars. So on these Tuesday morning webinars, I'd like to give a market update, and I curate some analytical reports, some analysts out there, and I then share those with you. I usually do a little bit from our Slack group. Many of you know, or all of you know at this point, that I'm part of Ed Slott's Master Lead Advisor Group, and it's just so helpful. You know, one of the things I do every morning is I go through the Financial Planning Association message board, and you know, these are certified financial planners from all over the country. And I often just think, boy, if these folks were just members of the Ed Slot group, they'd have most of these questions answered, if not through the knowledge, you know, the experience and the knowledge that we learned through the training, but just being able to access their group. So it's really just so beneficial. Like, for instance, I shared with you the Secure Act regarding the stretch IRA or the withdrawals of non-spouse beneficiary IRAs and the changes that from the IRS just last week, and that just came out the Friday before. So I still haven't heard much about it other than from the Slack group. So that's really, really helpful. So I want to remind everybody, so we do a market update. We do a typically something from the Slack group, and then I do a piece about financial planning. That's usually how we do this on Tuesdays, and then usually once a month we have a special webinar on a Wednesday evening at 6:30. I do hear from some people who are still working that they can't attend the 10 a.m. webinars, and they'd like to stay on top of things. So I try to do at least once a month. Or once a month, not at least once a month, but once a month, a Wednesday 6:30 webinar. So what's coming up on those webinars, since we're talking about it, is using annuities in retirement planning and Roth conversions, fiduciary assistance for powers of attorney, trustees, and executors. So I've had a handful of people that are clients who say, oh, you know, by the way, I am trustee of my father's trust and estate, and there's a lot of responsibilities that come along with that. And that's very important to know, and that's a specialized focus. I did a lot more of in the past, but I also do from time to time. It continues. I just had an attorney hire me for a client of theirs last week, just for that fiduciary assistance. And then the next upcoming special webinar on Wednesday evening will be investment fundamentals. So we'll just talk about, and we're going to touch a little bit on that on investment fundamentals today. We're going to talk about bonds and fixed income investing. This is a really important topic right now as interest rates are going up. But in this webinar, investment fundamentals, that I'm going to have on an upcoming Wednesday at 6:30, we're going to talk about mutual funds, stocks, exchange traded funds, bonds, individual bonds. Probably won't get into annuity investing, but we're just going to, and asset allocation, what that means, maybe a bit about account segmentation. So we're just going to talk about those investment fundamentals, just to give you a nice base to work off of as we talk about these different things. All right, so I want to remind everyone that you are muted. There's a Q&A at the bottom of your toolbar. Your chat is disabled, and these meetings are always recorded. And at the end of the meeting today, you're going to have an opportunity to schedule an appointment with me. If you're a client already, and many of you on this webinar are already clients, and you have something scheduled, like a financial planning appointment, go ahead and keep that appointment that you already have, because there's a lot of work to be done behind the scenes in preparation for that. But if you have a question about something and you want to have a phone call or a Zoom meeting, you know, tomorrow, the next day, whatever's available on the calendar, that's fine too. If you're not a client yet and you have not yet had a complimentary consultation, please feel free to schedule a time, and I'm happy to accommodate that. That's 50 minutes, 50 minutes that you'll have with me to answer questions you have, maybe plot out a tax efficient plan, or whatever you want to use that time for. If you have already had that complimentary consultation and you want to have another conversation, well, just reach out to us and we'll figure out the best way to get you there. All right, so let's get started. We're going to, I do first want to go over the Ed Slott updates, and let me just check in here. No questions before I get started. Hey, everybody, got a lot of people on today. So let me go over a couple of the Ed Slott updates. I thought this one was really good. So this was from Sarah Brenner, who's really my go-to person at the Ed Slott group. I call her often, and she's always very on top of things and very helpful. But Sarah wrote about 2020 Roth IRA contributions. So it's not too late. It's too late to do a conversion, right? You have to do that by the calendar year, but you can still do a Roth IRA contribution if you meet a couple of the requirements. And it's funny, Sarah gives so much good information. I typically highlight these things of things I want to read or point out to you, and most of her email is highlighted. So I'll just read it to you. Just the IRS, we talked about this a few weeks ago, but remember, the IRS has delayed the deadline for filing of your income taxes until May 17th of 2021. This also extends the deadline for making a 2020 Roth IRA contribution or a traditional IRA contribution if you can do that. But we're just going to talk about Roth IRAs here. It does not, remember, it does not or did not extend the timeline for your quarterly estimates. So you had to have your quarterly estimates in by the 15th of April for the first quarter of the year. But the filing is extended till May 17th, and therefore the contribution extensions. And just as a reminder, if you're under age 50 in 2020, the maximum contribution you make in a Roth IRA is $6,000. If you're over 50, that increases to $7,000. It's not an additional $7,000. It's an additional $1,000 to $7,000. Now, these are IRAs, not Roth 401ks. Roth 401ks are wonderful, but we're talking about IRAs. So you and your spouse, you or your spouse must have taxable income to be able to contribute to a Roth IRAs, and passive incomes such as just investment income, rental income, things like that, or Social Security, they will not work. You need to have earned income, taxable earned income. You're never too old to contribute to a Roth IRA. You may make Roth contributions at any age if you are otherwise eligible. So if you have the other eligibility, earned income, taxable earned income, then you're eligible. If you already contribute to a plan at work, it's not a problem. A lot of people think this, well, I contribute to my 401k at work, therefore I can't contribute to a Roth IRA. It's not true. If you meet the earnings requirement and you don't earn too much money, then you can make those contributions. And yes, you can make too much money. We'll talk about that. So as I said, the deadline for the Roth IRA contribution is May 17th, but don't wait until then. And if you file an extension, that doesn't matter. You want to have your contributions by May 17th. This is what I'm talking about. If you earn too much money, we have these phase out rules, and the phase out rules begin at a modified adjusted gross income amount of $124,000 if you're single, or $196,000 if you're married filing jointly. You get phased out of your ability to contribute to a Roth IRA at that point. It lessens and lessens and lessens until it goes to zero. So that's the Roth IRA information from the Slott Group. So another interesting piece that came in last week that I thought I'd share with you had to do with a 60-day rollover. Now, we don't see many of these because we discourage them quite a bit. So a 60-day rollover is when someone takes a distribution from an IRA typically into their name. So I receive a check from my custodian made out to Mark Byelich for $500,000 out of my IRA. And I say, I am going to take the next 60 days to decide what to do with this money, where to put it into another IRA. And you can do that. But the rules have gotten very, very difficult. First of all, you can only do that once per year. And we've seen problems where people say, all right, well, I have two IRAs. One is $500,000 and one is $10,000. and I'm going to roll them into an IRA, with Vanguard, for example. I was not going to say us because we wouldn't allow you to do it that way. But I'm going to roll it into an IRA, for example, and you take two checks. They come from two different places, let's just say, or they come from even the same place. And those two checks, and you hold them and you wait 60 days. And let's just say the $10,000 check comes to you on April 19th, and the $500,000 check comes to you on April 20th. And then you deposit them within the 60 days. And you make your you make your investments in your IRA. Well, what's the problem with that? Is that the $10,000 is considered a rollover, and the $500,000 is considered a distribution. So yes, it's a distribution under the new IRA rollover rules, the once per year rollover rules that are now a few years old. That's considered a distribution. So you'd have to pay tax on that entire $500,000. So you want to be really careful. Usually coming from a 401k or a retirement plan, that usually doesn't happen. But here's the question that came into the Slack group. So I had to put my glasses on for this to read it. A new customer, this is an investment advisor, a financial advisor writing in. And this happens often too. And then I often think, again, why don't these people just get involved in this group? It's so fantastic. I still can't believe there's only 400 of us in the entire country that really spend our time educating ourselves about IRA distributions, staying on top of the tax law changes, and all the wonderful things that this Slack group allows us to be involved with. So the question is, a new customer came to me asking for help with an IRA. Unfortunately, he had already accepted a check from the 401k plan made out to him personally. That's the key, personally. He sat on the check for 5 months and deposited into his checking account last week. He is only 50 years old. Since we're well after the normal 60-day rollover period, is there any way that this can be repaired, perhaps under the CARES Act of 2020, if his departure was COVID related? So that's a good question. We kind of have this 1 year window of with the CARES Act of getting things done. So this is written by a woman named Sally, and it was actually Sarah again who wrote back, "Hi Sally, if this individual meets the definition of an affected individual under the CARES Act, not everybody does, but many do. The 2020 distribution from the 401k could be treated as a coronavirus related distribution, or a CRD. An affected individual is generally someone who had the virus, had a family member who did, or who experienced financial hardship due to the virus. If this distribution qualifies as a CRD, then the individual will have up to 3 years from the date of distribution to repay it to the retirement account." She goes on to say, if not, you're basically in a tough situation. The IRS does allow for a self-certification process, but the moral of that story is never take a check into your name. Figure out where it's going to go to, and then distribute it directly to the custodian. And then you don't have to worry about it. Then it can sit for as long as it needs to, and you don't have to worry about it. Okay, so we haven't done a poll in a while, so I want to put a couple polls out there. So let me release these polls. I got to go to my main menu. And the first one I want to ask is about the stock market. Now, I do air quotes around the stock market because we all know that there's many markets within the stock market. But before I get into the investment portion of this webinar today, I just want to get an idea of how people are feeling out there. So let me launch this poll. And the poll reads, how do you feel about the stock market? How do you feel the stock market has performed so far this year? And the first answer is doing great, up and away. The second answer is okay, nothing special. The third is, woo, what a rocky ride. And the fourth is moving along pretty well, steady as she goes. So we're just going to watch this for a moment. Oh, this is great. Thank you for everybody for doing this. Okay, so far, it looks like that's about the end of it. Most of you are saying moving along pretty well, steady as she goes. Okay, that's a fair answer. A couple said, okay, nothing special. Some said doing great, up and away. And the third highest came in, what a rocky ride. And especially if you looked at the past couple of days, it sure has been a rocky ride. So let me end that polling. That's really helpful. Good. but moving along pretty well, steady as she goes, is the winner. Now let's check in with that and see if what you're feeling matches what's going on. So I'm going to first go to my favorite Invesco chart. There's a lot of information on here, and I just might share this again with you in light of what we just talked about. Now, usually I like to share things with you that you can get anywhere. So when I refer to a, excuse me, when I refer to a mutual fund or a stock, or I show you a quote, I usually use something like Market Watch that anybody can just plug into Google and get that information, or Google Finance, or something. But this is something that I get on a regular basis. And actually, it's a little too small for me to share with you, but let's go and talk about the markets. Where are we so far this year in the markets? Well, the Dow Jones Industrial Average, which is really the largest and most recognized index, is up 12.33% so far this year. Well, that's really strong, 12.33%. Just over the past week, it's 1.88. I can't do it without the glasses. 1.18. And from this time last year to this time this year, like the close of business on Friday, it's up 48%. So that is a really strong market so far. If we just stayed here for the rest of the year, I think everybody would be really happy. The Dow Jones Industrial Average is up 11.91, so really close to the S&P 500, which is the norm. And the NASDAQ, even though the NASDAQ's been having a really hard time this year, from what you see on TV and you see the charts, and you hear on the news, it's still up 9.24% so far this year, over 66% up from this time last year. So that's even the international markets are doing quite well. So 8.58, 4.79. Now, no part of the equity markets that I can see here, I'm sure there's some part of it, equity markets being the stock markets, are down. Now, the bond markets, on the other hand, and we're going to talk about this in more detail in a bit, are down pretty significantly. So the Barclays Aggregate Bond Index is down 2.56%. So that may not seem like a lot, but it is a lot when you're expecting bonds to be your safe investment. And as I said, we're going to talk more about that, so I don't want to take too much away. But that may surprise some of you. The majority of you thought, pretty steady as she goes. I don't know if you were thinking a 12% year to date, but there's been some volatility. We're going to talk about some of the analyst statements, but so far, a really, really strong year in the overall stock markets. So I hope that was helpful. The big winner this week for the analyst reports, and the one I liked the best, was Riverfront. So Riverfront's out of Richmond, Virginia. I don't invest with Riverfront Investments. I've told you before, there's a group of individuals I got to know at Wachovia Securities when I was there. And Doug Sandler is the person who wrote this post. And Doug is a really sharp guy. And there's a few others who are involved in that group, but I just can't remember their names now off the top of my head. But the takeaway for this was they were talking about the economic data is clearly showing that 2021 is going to be a banner year for the U.S. economy. That's really good to hear. And we've talked about that before, and some of the pent up desire and funds that are out there. People want to travel, they want to go out to restaurants. My wife and I are doing some traveling this weekend, just locally here in Pennsylvania, but I'm really looking forward to getting away. Well, this will likely lead to greater optimism among consumers who now have the highest savings rate in more than 45 years. Well, that makes sense. But be aware that the strong returns over the past 12 months mean that investors have likely anticipated much of this good news. And they talk about in this piece the comparison between Main Street and Wall Street. And I thought it was really interesting. We've heard that before, but I think it's really timely right now. So they go on to talk about vaccine distribution and how that's quickly climbed and how people are feeling more comfortable being out. And you see that, I'm sure, as you go out and you just see more people out and about. I was getting gas at Costco because that's the only place I get gas. And I was looking around the other day, and there's a lot of cars, as there usually are. And I noticed that most people were standing outside without masks on. And I don't want to get into the mask debate. I'm just saying that's a comfort level that people have to be outside. Now, everybody, of course, inside still has them on, but being outside of the gas pumps and be able to breathe the fresh air, I guess, around the gas pumps. That's a bit of a turnaround than it was just a few months ago. So just that sense, I thought, okay, things are starting to really feel differently. Savings rates are exponentially higher, hovering near 15%, as I said, the highest in 45 years. The influx of government payments, whether it's a stimulus check or tax refunds, people are expecting some money to come in, and that's likely further to prime the pump. And then they talked about Wall Street reflects the future, Main Street reflects the present, and I thought that was a really interesting look at it. The market is beginning to look beyond 2021, and will start reflecting when it sees 2022, or reflecting what it sees in 2022. But unfortunately, this is the market. Unfortunately, 2022 is unlikely to be as universally positive as 2021, they say. In fact, 2022 is already harboring its share of boogeymen, higher taxes. Folks, when I started talking about higher taxes as being a major issue in 2011, I got a lot of pushback. As we moved forward in 2015, 2016 is when we really turned a corner, and we were doing a really strong focus on retirement planning and tax efficient retirement planning, and getting people to that 0% tax bracket, or the most efficient tax bracket they could get to. Still more people were getting on board, but I was still having conversations with accountants sometimes, and I still have them today about the risk of higher taxes in the future, but hardly anymore. People know it's coming. People are concerned about it. Unfortunately, our window is super small now. It used to be back in 2017, we had this great opportunity, and that window is just closing very quickly. But higher taxes, fading stimulus, fears of inflation. We started talking about this concern about inflation probably this time last year. One analyst started I think it was BlackRock, started talking about it in every report, and then they all started picking up. So here we are now. Everybody, it's nearly 12 months later. Everybody's talking about higher inflation. We talked a lot about inflation on our last webinar last week. I showed you the consumer price index. Shifting Fed policy, midterm elections, and these are just a few of the concerns. So midterm elections are going to be very, very challenging. And then they look at the size of Wall Street compared to the size of Main Street. So it was interesting to be reminded for myself, and I think it'll be interesting to you. Public companies, and they're companies that trade on the stock exchanges, they represent less than 1% of all U.S. companies. So we put a lot of focus on that, and that's where people can invest most of their money, who aren't small business owners, who don't invest in community businesses or community projects or private companies. That's just less than 1% of all U.S. companies. Publicly traded companies account for roughly 1/3 of all U.S. non-farm employment. Therefore, 99% of the U.S. companies and 2/3 of employment come from Main Street. So we all know that, but it's really nice to be reminded of that. So Main Street companies are often smaller. Many are sole proprietors. They don't have a lot of this capitalization that the big companies have. They really, they're really basing their survival on what they've done in the past month, or maybe if they're well positioned in the past year. And God forbid it's the past week. But I had a bakery. I owned a bakery with my sister many years ago, and we had it for a few years. It grew really well. It just turned out that wasn't her passion, but that's okay. But it was still challenging, even with all the growth we had and the great success we had. It was really challenging. And if we had a tough week, you felt it, right? And sometimes you had to put cash in to cover payroll, things like that. But there's a lot of mom and pops out there, brothers and sisters, or stores that are acting that way. And of course, the Main Street companies have been had much greater impact from the state mandated shutdowns, and are less able to shift to work from home. Thankfully, we're a small company, but we're able to work from home. Everybody's still working at home as renovations are getting done at our building in Newtown. So Wall Street, again, focuses on the earnings and stock prices. Main Street focuses on wages and home prices. It goes into talk about, and we're running short on time, but it goes into talk about how tightening labor markets are can be good for Main Street, but not so great for Wall Street, and just a balance. But the conclusion is that they believe that both Wall Street and Main Street will be, they say, smiling through 2021. And Main Street will probably have continued growth in 2022. Wall Street, on the other hand, has all these concerns we're talking about with that I talked about before: higher taxes, higher inflation, the midterm election, and there are a few other things. But it's going to be interesting to see how that plays out. So it really is. It tends to be, again, Wall Street looks forward, and Main Street is affected by what's going on right now. So I thought that was a really interesting piece. So Riverfront really wins the day on that. All right. So let's move on to the financial planning segment of this, and we're going to talk about bonds. This is really an important topic. Let me just check in to see if there's any questions. No questions. Okay, everybody. So I'm going to share my screen, as I often like to do. Okay, so hopefully, so Zoom used to do this thing where it had a green line around the screen that's being shared. But if you can see my whiteboard, please raise your hand. Okay, wonderful, thank you. I don't know why they changed that, because it was nice to be able to see exactly. I've got 3 different monitors I'm looking at here, and it's nice to see what I'm showing. Okay, so this is bonds and using bonds and investments. So I have another poll. Hold on one second. I forgot about that. So let me launch this poll. All right. So this poll says, what about bonds? How do you feel about the bond market so far this year and going forward? And the first question, this is just 2 questions. I want to keep it easy. Bonds are steady, safe investment. And the second answer is, look out below, bonds are falling. And right now it is a 50-50 race. And that's really interesting, but only 2 of you people responded. So let's get some more responses. Okay. All right. This is interesting. Okay, this is really interesting. And so far, 62% of you say, look out below, bonds are falling. I hope I've had some impact on that. So I hope that is because of some of the discussions we've had on these webinars, because I shared with you that this is an area I'm looking at very strongly in our portfolios this week. This is my my week to review portfolio reallocations, and we're looking at it right now. So 60% of you said look out below, bonds are falling. 40% of you said bonds are steady, safe investment. So let's talk about that. Good job. Thanks everybody for participating. All right, let me close that up. So back to the whiteboard. We're going to talk about the yield curve and what that means. We're going to talk about buy and sell, and we're going to talk about passive versus active. And we're going to talk about this 60-40. I shouldn't check these because I want to make sure I get all of them. Wow, look what I did. All right, let's undo them. All right, there we go. So I just want to make sure we hit all these. So I want to talk about the yield curve because that's something you hear about all the time. And I included this chart down here to discuss the yield curve. So let me move this up. Now, those of you who are new to this webinar, I'm looking down right now because I have a tablet and I move it down so I can, because it's really hard to draw up in the air. So if I'm looking down, you're seeing the top of my head, don't let that bother you. So what the heck does a yield curve mean? Well, what I have in front of you here is from the U.S. Treasury, daily Treasury yields. So anybody can go to www.treasury.gov, and I'm looking at my other monitor where that is. And you can see in the resource center, you can see the daily Treasury yield curve rates, and you can pick different years. So of course we have here 2020 and 2021. So I have 2020, 2021 because I just wanted to show you what's going on here. This is a really good snapshot in time. So here we were, I'm over here in the 20-year Treasury. Well, actually, let's go to the 10-year treasury, but we'll stay there. This time last year, 2020, the 10-year treasury was at 0.63%, below 1%. I have to tell you, I don't remember in the 20 some years I've been doing this, I don't ever remember treasury yields, 10-year treasury being below 1%. And I'm certain it wasn't, but I often, without researching, I hate to speak uncertainty, but I can't ever remember it though. And if Walter is on the webinar, he'll tell us, he'll send me a note. But it's up, nearly 1%. Year over year. That's a lot. That's a big move. But you'll see that the 20 years 2.18, last year is 1.04, and 30 years 2.29, last year is 1.23. Well, what does that mean regarding yield curve? Well, if we start at the 1 month here and we go all the way to the 30 year, you'll see it goes up progressively. It's a little flat here, 2 to 3 months. That's not really meaning anything. But you'll see that it progressively goes higher. So if we start at 1 month and we go to 30 years, right? If this is, let's give it a 5%, and this is 0%. I just did the chart backwards a little bit. That is your yield curve. As the years go, it gets higher. Now you've heard things maybe about inverted yield curve. That simply means that short-term rates, and it's not usually 1 or 2 months, it's usually 2 years or really 2 years, maybe 5 years. But that's, of course, where yields are higher and then they drop down. So this is normal. A regular, this is a typical yield curve where it starts lower, it goes higher. Inverted yield curves, there's a lot of concerns about when we see inverted yield curves. I'm not going to get into that because that'll take too much time. But that's what we talk about yield curves. So any questions about that before I move on? That's the simplest explanation I can give for that. Okay. So this gap here is going to become really important in just a moment because most people believe this. So when my next point is buy, sell. Buy, sell. If most people believe that bonds are the safe investment, and most people buy bonds to offset the risk of stock. That's what we were all taught, just like we were taught, tax-deferred investing is the way to go. And typically, in a normal interest rate environment, that's not necessarily a bad thing. But as interest rates rise substantially, and I would say these are substantially, it can be a real concern because you've got to buy bonds and then at some point you have to sell them, don't you? Now, some people might be saying, yeah, but you can just live off that dividend, right? Or that yield that you get off of those bonds. Well, tell me, how much living are you doing at these rates? Even if you go out here to 30, how much living are you doing if you put a couple $1 million into 2.2%? Not a lot. So very few people are buying bonds with the idea that you're going to be taking the yield out of them, especially when inflation. Remember when we looked at inflation? If inflation is at 2.5% and you're yielding 2.9%, well, after taxes, you're way negative. So first of all, you're starting at a positive 0.04%, and then you got to pay tax on that money. So your after tax rate is probably, I don't know, let's just call it -1 to be generous. Negative. So that's no good. So you're actually losing money after tax every year. So you got to be careful about that. So most people go into bonds with the idea that they're going to have them at buffer the stock market and they're going to sell them at some point. So here's the risk. In 2020, let's use this chart above us. In 2020, you bought a 10-year treasury. Let's use the 10-year. Let's highlight this. We're right here. So in 2020, you bought a 10-year treasury bond, and that has a yield of 0.63%. And these trade in $1,000 increments, typically. So you spent $1,000 and you bought a 10-year treasury because these are risk-free bonds, right? And so if you hold it to maturity, you're going to get your money back unless the federal government defaults or the municipality defaults or whomever you're buying these bonds from. But right now we're talking about treasury bonds, U.S. treasuries. So $1,000 is what you paid for that. Now here we are in 2021. Let's say that you want this $1,000 back. Okay, you invested that money last year, that $1,000 in a US Treasury bond because you want to be safe. You didn't want to lose any money. But now you need that money, or you want that money. You want to invest it in something else, or you want to spend it. So now you go to sell it, right? Here's your buy. Here's your sell. Now you go to buy it in the open market, or sell it, excuse me, in the open market. Well, a buyer of your bond has the option of buying a 10-year treasury for $1,000 and making 1.61%, or buying your 10-year treasury at 0.63%. Well, which one are they going to buy? They're going to buy the new ones. As long as they're available, they're going to buy the new ones there, and they're available. So what happens to the value of your bond that you own that's only paying 0.63? Well, it drops down in value. So what happens is you may only get, I'm not going to do the math, but let's just say you only get $700 for that bond that you bought $1,000, you paid $1,000 for. Now, let's multiply this times 100, because people don't just buy 1,000, right? So now it's, you invested $100,000 into this, and you're only getting 70,000 when you sell it. Well, that's a big hit. So that's a big, that's 30%. That's a big drop. That's not what we're saying, but I just want to show you the math behind it and how it works. So that's the risk of putting your money into bonds while interest rates are going up. Does that make sense? Let me check in. Any questions about that? Okay. So if I don't hear questions, I'm going to assume that it makes sense to everybody. All right. So that's the buy sell. So now you could just, again, hold this for 10 years and you're going to get that $1,000 back. But what are you getting along the way? You're getting 0.63%. And can you live off of that 0.63% along the way? Maybe if it's just balancing the equity side of your portfolio. But the problem is that most people don't hold them for 10 years. And then we get into the third section here, which is passive versus active. And this is the real challenge, folks. What does this mean? Passive versus active. Well, passive is index investing, or ETFs, or exchange traded funds. All the rage, right? With me too. I invest in a lot of exchange traded funds because they're efficient and they're very, 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 very cheap to own. Well, the problem is the index is going to do what the index is going to do. Typically, these are non-managed. And in this example, if they own all, this wouldn't be the case, but if the index owned all 10-year treasuries that they bought last year and had a yield of 0.63, and then they had to be valued again, not necessarily sold, but valued again this year, well, look at that big loss you have. And that's what we're seeing right now. That's why when I went back and I told you that the Barclays aggregate index is down 2%. So is that 2% likely to get larger or smaller? Well, as interest rates go up, it's likely to get larger. So if these index funds or these exchange traded funds, they're going to do whatever the index does. So if your exchange traded fund or your index fund, and these are different, there's two different things. If they're tracking the Barclays aggregate index, which is the most common for bonds, well, then your fund is going to be down about 0.3 to 3%. Same with this index fund. So that's where people get a little anxious. Well, wait a minute. I just had this conversation with a client because they're relatively new clients. All their equity investments are up, but one of their bond funds, one of their 2 or 3 bond funds are down slightly, about 2%. Now that's an area I'm paying close attention to, but that sometimes is the balance, right? You can't always expect everything to be up in your portfolio. So it's not that this is a bad thing. You just have to be aware of it, because it could be that it's going to ride out over time and it's going to help offset. You're going to see the growth in your equity side, but you're going to see a drop in your bond side, and that's okay if you expect it. the problem is this passive, you really have no control over it. So now what is active? Let's talk about active. Well, these are managed funds. So you have people or some process. And these can be mutual funds. These can be what we call separate account managers. So they'll own the individual bonds in a portfolio, or it could be a portfolio manager. So we use mutual funds and to some degree separate account managers. So the benefit of the mutual fund is if you have a good manager or a good bond manager, they can structure their bond or their fund, their portfolio in a way that's going to minimize the downside or potentially get you and some growth in there. And they do that through looking at the duration of the bonds that they hold. So how long those bonds are going to exist in the portfolio, the quality. Sometimes lower quality bonds will give you a higher yield so that you can make up that difference. So if you're getting a 3% yield and the portfolio is down 2, you're actually positive 1. So there's things that a manager can do that an exchange traded fund or index can't do. I'm not advocating one for the other. I am just telling you the difference, because these index or ETFs might cost you 0.03 to 0.10% to own. A mutual fund might be 0.4% to 1% to own. So this is where the value of the team that you put together, including your money management team, has to be determined. Because if your bond funds are positive and you're paying 0.4% to 1% to have that positive return and still protect your investments, your stock investments, then that may be worth the money. So it's not always the best thing to go the cheapest route, especially when you don't understand the risks associated with it. Again, I'm not advocating for one or the other. I like ETFs and index, well, more so ETFs for me. I also use mutual funds. And then there are other options. You can use closed-end funds. There are certain things that you can plug into a portfolio during this time or any time. Now, I've shared with you what I'm looking at is putting funds in there that rise during rising interest rates, that maybe have some safeguards in place. So there's things that you can do in building a portfolio, and it is challenging. The fixed income side or this bond side is the most challenging, and it always has been, in my opinion. So that's passive versus active. So a lot of conversation. I just want to say it again. You read articles and books from these broad-based financial gurus who are preaching to everybody and aren't focusing on your needs. And they'll say, you should use this type of fund, or this type of fund for whatever reason they talk about. But it depends on what your specific needs are. And then you got to have a decision about, okay, what does it cost to spend some money on a fund or not to get the results you want? So I hope that makes sense. Now, what's our next topic? 60-40. So what is 60-40? Well, 60-40 is that famous portfolio that people talk about. All right, 60% equity or stock, 40% bonds, or could be the other way around, right? It could be 60%, 40% bonds, stock. So the risk of the increased risk of bonds can sometimes get you there without knowing it. And how does that happen? Is that, well, you heard about the 60-40 split. And some people say, this is another one of those rules of thumb that drive me crazy. Well, if you're 60 years old, you should have 60% of your portfolio in bonds. Well, that's crazy. That's ridiculous. Those rules of thumb, most of them just throw them out the window. It all depends on what your needs are. And if you've been listening to me long enough, or you're a client of ours, you know that it goes far beyond the 60-40: account segmentation, asset allocation, principal protection. These are the 3 tenets, in my opinion, to build a strong portfolio. So, but how could you end up in a 60-40 portfolio? Well, one of the best, in my opinion, what do they call them? Lifestyle funds or age-based funds is T. Rowe Price. T. Rowe Price does about the best job. It's so hard to write on this thing sometimes. Best job with these lifestyle funds or age-based funds as probably I've ever seen. But here's the problem. What are they designed to do? Well, you start with a portfolio, looks like this. And as you move through your life, it gets more conservative and you may end up with 70% bonds and 30% stock. Just naturally. And most people do these things in their 401ks and they don't even realize it because they say, okay, I'm going to pick the 2025 retirement fund. And suddenly it morphs into this big bond allocation. And you say, okay, well, that makes sense because I read somewhere in Susie Orman's book or whomever that I should have 60% because I'm 60 and then it should be 65, you know, and I'm not sure if Susie says that, but I know there's plenty of people who do. That's what it should be. And then suddenly this drops 10%. Well, holy cow, I didn't think that could happen in a bond portfolio, right? Well, now you know, because you listened to this and we talked about the issue here, that of course it can happen and you understand why. But you could end up there without knowing it, couldn't you? And that is, by the way, these target date funds, that's the word, target date funds. Target date, sometimes they're called age-based. These are the most popular in 401k plans. And still the majority of our country has their money in 401k plans and in tax-deferred 401k plans. So it's not all about tax-efficient investing. It's very, very important, as you all know. And, you know, we make changes in people's lives that are life-changing for sure, as far as tax-efficient investing. But you also have to have the fundamentals. And the fundamentals are, you know, that's why this is part of the financial planning discussion. Part of financial planning is investments. You know, one of the most difficult sections of the CFP when I was going through it, and I think anybody who's done the CFP successfully will agree, is the investment section, because it's not just about, well, what are the basics of investment, you know, stocks, bonds, and cash, and alternative investments, but you have to do crazy calculations with standard deviation and alpha, you know, all these crazy things, but it's part of financial planning. So it's vitally important. We spend so much time talking about our financial planning and our tax efficient strategies because they are so different than what other people do. But you cannot forget about the fundamentals of investing. So rather than, and I see a question out there, I'll get that for a minute, but I just want to tell you those three tenets, right? Asset allocation, principal protection, and account segmentation. I know my writing is really bad in here. So asset allocation is, of course, developing your pie chart that makes the most sense for you and having the right components in here. And the right components may be ETFs. They may be mutual funds. They may be individual account managers. And you make sure that they're the best that are available out there, and you do that rebalancing strategy and all the things that we hear about all the time from traditional asset managers. And most people do this really, really well. Across the board, you're probably going to be hard pressed to find a firm worth their salt that's going to do a bad job with traditional asset allocation, because it's a well-proven strategy, and there's a lot of great tools for that. Principal protection. So that's your first thing. Principal protection is number two, and that is determine how much of your money you want subject to market ebbs and flows, whether it's stock market or bond market, and then set that money aside. We usually start at about a third. Well, we'll call it 33.3. So if you got a $1 million portfolio or $2 million portfolio, which is about the norm for us, you take about $600,000 and you put it into something that's principal protected. So you might earn 3 to 5%, but your worst year ever is going to be zero. So you'll never go below. You'll never hit that negative 2% like you're seeing in bond funds right now, or in exchange traded funds. And then the rest of this remainder, right, your 2/3 over here, then you're going to have allocated for growth in different areas. And then that's number two, that's principal protection. Number three is, say it with me, account segmentation. Now we take that remaining principal protection, or excuse me, asset allocation, and we say, okay, so we have $1.4 million here. And most people will say, well, we're gonna invest this wisely and make sure that we're following whatever investment strategy they follow, and they're going to use Monte Carlo simulation to make sure that all that money's here for the rest of your life. We say, okay, here's your retirement, and we want to get you to where you're no longer here, right? Well, instead of having this one portfolio set up for the next 35 years of your life, give or take, how about we break it up and we have several portfolios that are very specific to the time that's needed, and we make those fit into those segments. So instead of this being a moderate growth portfolio, assuming that it's, or even an aggressive portfolio, whatever fits your needs, assuming that it's going to do great throughout the whole time, or at least it's going to be there during your time, come lows or highs, we'll take a portion of it, whatever it is you need. Say you need $200,000 in this first 3 years, and we'll put it in a very, very conservative portfolio. And then as we go, 3 to 5, 6 to 6B, 6, 7, 8, 8 to 11, and then 11 plus years. As we go, we make it more aggressive, right? So where here you probably have a 100% stock portfolio, and we can get significant gains here. And this might be an 80% to 20%. So 80% stock, 20% bond portfolio. And you can have growth here, but the majority of your money that is subject to the rise and fall of the markets, you're not going to need for the next 8, 9, 10 years. And most people, that helps them sleep well at night. And we're with account segmentation. Remember, we're helping to eliminate the worry that people get coming into retirement, and usually the first few years of retirement. And then we also want to overcome that FOMO, or that feeling or fear of missing out, because at some point, if you're too conservative because you want to cover this worry zone, you're going to get to a point and say, oh, geez, if I would have only done this, I would have had more money. And sometimes you need more money later on in life. So I think that makes sense. We know where your money's coming from. We actually designate these accounts: segment 1, segment 2, segment 3, segment 4. You can't see that, segment 5. And it could be as many as 9 segments, or it could be, there's no limit, but that's the norm, 4 to 6. But people usually say, oh, geez, that makes sense, because now I can see where it's coming from. We have an opportunity for growth, and we're protecting the money that we need in the short term. Well, of course it makes sense. And I'll just abuse this analogy that I've been using. When I first came out of the Air Force and I worked in San Francisco, they built their buildings on a foundation, understanding that there's going to be rocky times, that they're going to have earthquakes, but it won't collapse the building. That's what we want in your portfolios. We got to understand that we're going to have rocky times. We want to prosper in the good times, and we want to protect in the difficult times. So I believe account segmentation, principal protection, and asset allocation are really the tenets that build that foundation for us. So I hope that makes sense. I don't ever want to show you the problem without showing you a solution. So I showed you the problem with the bond funds, and I showed you the solution with the account segmentation, principal protection, and asset allocation. So I've got 2 questions here. There's Walter. Kathy says, from Jack, how do municipal bonds fit into a taxable portfolio? Do they ever have a place in a non-taxable account? Well, do they ever have a place in a non-taxable account? Well, of course, there's times that they do. So a good example is, there were some times this time last year, when the spreads between the bid, what the municipal bonds were worth and what they were being sold for were pretty high, because we had concerns about defaults in municipalities. So if all your money is in IRAs, whether it's Roth IRAs or traditional IRAs, and you wanted to buy municipal bonds because of that price differential, right? We call it an arbitrage. There's an opportunity for growth between pricing. Well, then that might make sense. That happened during the that same thing. Similar thing happened during the Great Recession. I can't remember I think her name was Meredith Whitney. Meredith Whitney came out and she said, there's going to be tremendous defaults in municipalities around the country, and the municipal market dropped significantly. And it was a great time to buy municipal bonds. And I bought some in retirement accounts just because we were looking at, AAA rated municipalities that really didn't have a chance of default or much of a chance of default, but sometimes. So you can't say never. Typically, Jack, no, or Kathy, tell Jack. Typically, you're getting a lower yield on your municipal bonds than you would on a taxable bond, and it doesn't make sense. But there are times using that pricing differential where it can make sense. So I'm reading Walter's response. So from data at the St. Louis Fed, yields on 10-year treasuries climbed from 4% in the 1960s to a peak of 15.84 in 1981. So in 1986, I think it was, maybe 1985, I opened up my first money market account, and I think it was 14.8%. Then they fell from 1981, Walter's telling us, for more or less steadily to a minimum of 0.55 in July last year. So and I don't think we've ever seen a breakthrough below 1% during my 20 plus years now that I've been doing this. But Walter, that's great information. So Walter's on these webinars all the time, and Walter's doing his PhD in finance. I'm going to just generally say finance, Walter. I know it's much more detailed than that, but I appreciate the response and the backup as always. All right, folks, it's 10:56. I don't see any other questions. Thanks for hanging in there. We will see you next Tuesday. Keep an eye out for those special webinar invitations. And that's all for today. Enjoy your day, and we'll see you next week. Take care. Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.